Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, PIFinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on today, Jim.
Drew, the precious metals have been getting a lot of attention with gold setting new record highs, but it had a huge sell-off yesterday. What do you see for gold prices going forward?
Yeah, I mean, anytime we see this kind of price action, especially when it's sustained to the upside, you get a lot of investor interest. You get a lot of people wanting to get into the metal, a lot of people that have been, in the metal for some time, getting that vindication of seeing new highs, they knew they would be right eventually. There tends to be, a lot of people like that in the gold market, more specifically than a lot of other markets. But the setback yesterday, again, I think is one just because we were seeing such a run up, maybe a little bit of a speculative top near term. I mean, I think to hit the new highs, we were up 13 out of 15 trading days, a big rally in 3 weeks, maybe even more, impressive than the gold run was the move in silver. I mean, in that same time period, we went from $20 to $30. So a 50% move really in 3 weeks was even more aggressive, bigger daily volumes compared to previous daily volumes that we saw in silver, but also a more aggressive pullback in silver as well. So I think going forward, I mean, a lot of this has been the talk of, we're finally going to see inflation because we now have, fiscal monetary, pushes where in the previous sort of look back period when we had QE, when we thought we were going to see inflation, that was more just the central bank really pushing on the stimulus side of things. So with both central banks and governments giving it their all this time, that we will see that inflationary reflex that should cause things like precious metals to do a lot better. So I think in order to look at that, you've really got to look at the real interest rates. That's been a very good barometer for what's been driving the precious metal markets the last little while. Of note, with gold setting back, we've also seen the interest rates move back a little higher, so that's going to work against your real interest rates. But then we just got inflation this morning that was a little stronger than was expected. So again, maybe there is something to this inflationary push going forward. Again, we're still sort of bouncing back to levels that are well below the pre-COVID levels on the inflation numbers. But again, it is stronger. There's definitely some very serious strength in some sectors of the inflation number, which if they carry on, could maybe take us back to and or well above those previous numbers. So I do think that, over a longer term, and I mean a couple of years when I say that, I do think the precious metals area is going to be a very good sector to be in. I do think that we are debasing our currency to some degree with the amount of money that's being issued, printed, handed out in all sorts of various ways. And I do think that will come back to an inflationary impulse. My worry is that near term, I've been explaining what I think has been a sort of a financial holiday or a financial band-aid on the consumer side of things where, bills have been cut with, mortgage deferrals in the U.S., outright checks coming in, unemployment insurance being high or even higher than some of the lower minimum wage jobs. So there wasn't a deflationary aspect from COVID that's really taken root yet. And we've seen that, like I just mentioned, in the inflationary data this morning. But I do think that we might see that coming ahead in the fall. So we're waiting on another round of stimulus out of the U.S. government. Whatever that looks like, it's looking like it's going to be less than the previous package was, as far as for the individuals. So there might be some impact where I think going into this fall, we may have a bit of a deflationary wave or deflationary impact that's still, yet to be felt from COVID. We know a lot of small businesses are closing. So again, if you have the lower wage people looking to go back to a job, all of those jobs may not be there. And I think that is going to be where we're going to start to see maybe some pullback in some of those numbers. So again, broad term, yes, I do think the precious metals market is going to be a good market over the years to come. Near term, especially with sort of the speculative run up that we saw, I think that, maybe it's a pretty risky spot still, even after a $100 sell off yesterday. I do expect it to be volatile. So again, sizing your investments accordingly. But then at the same time, I would say as we go into the next couple of months, looking at, levels where you're comfortable to be a buyer. And if it goes lower than that, where you're comfortable to be a buyer again, in the precious metals market. So I am bullish over the long term. Near term, still thinking that we may see a bit of a deflationary wave from some of the economic pain that we've maybe delayed, but I do think that's coming. So good over the multi-year period. Near term, I'd be a little tentative, maybe even, again, harder to say after a 100-day sell-off, but maybe taking a few chips off the table at some of these levels, looking to be a buyer again a little later.
We'll have more with Drew Zimmerman right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, the NASDAQ has set new all-time highs. A very bright green board on Bloomberg today. What is going on with the NASDAQ and other stocks pushing them higher right now, even though we're so nervous about the economy?
Yeah, and that was just, as I was explaining, the precious metals market. I do think that we are debasing what our currency is, and in that environment, you want to be in assets. And at the same time, we've got interest rates that are scraping the lowest that they've ever been. Again, a little move up in rates here in the last few days, but it really does beg the question of what do you want to do with your capital? Do you want to put it in 10-year U.S. paper and get 0.5% a year? At that rate, you're getting a negative real return, because inflation is going to be higher than that already. So if inflation is going to pick up more, again, you're going to be losing out. You're actually going to be losing your capital. So that, I think, is what allows other assets to become that much more attractive. And again, if you go into the valuation side of equities, when you really lower the interest rate, you're really making the forward cash flows that much more valuable. So the valuations, although, you could say they are stretched. I mean, it's been a very one-way market ever since the March lows, much more than I think a lot of people were thinking or forecasting. Obviously getting both the NASDAQ to new all-time highs, and as we stand right now in the S&P, I think we're a few points away from all-time highs. So, very high equity market. But again, it comes back to the question, I think, broader term of, we've put a lot of excess money, excess liquidity into these markets. That capital needs to go somewhere. And right now, if you're asset allocator, the liability side, that is going to be bonds that have such low interest rates. I mean, even with the Fed going into some of the junk bond markets, really driving down the yields of what may be not even an investment grade company, having very low returns, that risk reward scenario doesn't balance. You might be much more willing to take the risk of a good utility company or other business that is growing cash flows, that's paying a good dividend. And yes, you've got the capital risk, but you've also got the capital appreciation upside. So, I think that's where, more and more investors are realizing they need to or have to turn to the equity market. And I think that's what's really driving these prices higher. So as much as, there does seem to be a disconnect with economists where they're, pointing to the real economy that we have where, small businesses are closing, small businesses are struggling, we still have, a lot of liquidity in the system. And, maybe we're waiting to see what this next package out of the U.S. government is going to look like. And I am looking at that event as something that, may cause another jump higher or another move higher, in equities as more stimulus, as more liquidity hits the system. And I'm going to be very interested to see the price action, around those 2 days to see if we get any sort of run up that can't be sustained, or with the example of the S&P getting right back near all-time highs, if we sort of break above those all-time highs, but don't really have a lot of momentum to go much further. I do think we are seeing some signs of exhaustion, in some of our equity markets, some of the U.S. equity markets, I should say. So I'm cautious at these levels. I think if you are invested, it's, be sitting near the door, but also understanding that as long as the music is playing, you need to keep being there. You need to keep staying, invested. So it's a very, tricky market right now, and one to say that, even though it's maybe separated a little bit from the economic reality, the economic reality now also has to take into account, record low interest rates and a huge amount of stimulus, both on the central bank and government side. So, I think I would be, nervous if I was, fully invested at these levels. But at the same time, realizing that you need to stay invested to some degree because, as I've said before on this show over the last couple of months, I've been skeptical of this equity move, where we just have continued to grind higher over the last couple of months. So, I've been looking for opportunities to look for the selling opportunities, I guess, in this market with a limited risk, setup. But again, we continue to see, all short-term sell-offs be bid fairly aggressively. And, we're not able to make lower lows and lower highs, which would tell me that we're seeing a change in trend. So right now we continue to see higher highs and higher lows. And that's just something that, needs to be respected in this market. And again, I think it's more about, asset prices in all different classes going up as we slowly sort of debase our currencies. That's, I think, going to be the big theme over the coming couple of years. But like I say, I just as with the precious metals, I think the same thing is going to be with the equity market, where I am worried that there could be a bit of a economic bite or a deflationary wave that sort of comes through as we go into this fall, especially if there was to be another pickup in COVID cases. I know the U.S. obviously, from the initial sell-off, we had that second wave in the U.S. where they were having over 70,000 cases a day, and that really didn't seem to impact the equity markets like we thought it might. So if there's another wave, again, if we're working towards a vaccine like we keep getting headlines about now, maybe if cases pick up again in the fall, it's less of an issue because the thought is that we're going to get over it sooner than later. But at the same time, I am still looking for a bit of a pullback in equities. It's been, just a fairly solid straight line move up from here out of the March lows. So I think a pullback would be justified. I don't think we need to, crash down to anywhere near the lows that we were at before. That was a very uncertain time. We definitely have a lot more information and have done a lot of work towards the COVID virus itself in that time. But at the same time, there is an economic reality that I do think has to come back into play a little bit more. And I think that sort of deflationary aspect could take prices a little lower near term.
We'll have more with Drew Zimmerman right after the break.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, the U.S. dollar has also weakened quite a bit over the past few months. Do you see the U.S. dollar continuing to slide lower?
Yeah, there's been a very popular opinion the last few weeks. A lot of what I've been reading on the commentary on the U.S. dollar has indicated that, it's peaked out and we're about to see the U.S. dollar, continue to slide the dollar index as we are now just over 93 in the 93.5 range, basing around the 92.5 range a little while ago. It's been a very Euro-centric move in the last 2 months, especially. To me, that key date was the middle of May 18th, when Macron and Merkel both came out and declared that they had come to an arrangement to issue joint European debt. Now, that took more time to sort of work its way through the system in Europe, but again, that was sort of the key turning point where the euro rallied 10 cents from about 108 all the way up, above 119 here recently. So a lot of people have been saying, that was sort of the next stage in the Euro group's sort of playbook in order to continue to become a more united front. It's my view that was more of a, last minute, we really need this to hold everything together, not a, well thought out, well planned event that's going to, bring us together and we're going to have solidarity moving forward. I do think that was a COVID response that was patched together more quickly and was necessary. So it is, I think, a good thing that they did it. But at the same time, I don't think it's maybe as well thought out and a structured arrangement as maybe some would hope. We'll see what that means for the euro going forward. But for me, looking at the U.S. dollar, having sold off fairly aggressively, a lot of the positioning leaning fairly hard against the U.S. dollar at this point, a lot of the emerging markets didn't have that same reaction against the dollar that the euro has. So it's been a less broad weakening of the U.S. dollar. Like I say, a lot of it centered around the euro itself. So I do think that 92.5 in the dollar index should hold. I think that if we go into any type of risk-off event, obviously that we haven't seen in several months, that the U.S. dollar could get a good bid to it again. I think the, economic outperformance between the two economies is going to be key. I'm continuing to think that, Germany was in a manufacturing recession before we went into COVID. Obviously, COVID was a lot worse. They have done a tremendous amount of stimulus as well to help their economy. But again, they're going to need those export markets to really export to really get their economy going. So I think the economic outperformance of the U.S. Will be important. So as we watch the data going forward, I'm going to be really looking at the shorter interval data that we have on the U.S. economy to see how it's performing. I think the consumer as of now is in a decent shape, with savings rates having gone up through the pandemic, which will help the U.S. because again, they drive a lot of their own, economic fortunes. So that's going to be an important thing to watch going forward. Gasoline price is still relatively low, which helps the, not very, very low, but relatively, helps the U.S. consumer as well. So, I'm a buyer of the U.S. dollar. Again, looking at the recent low to hold. So again, on a medium-term basis, a good risk-reward set up there, I think. But again, it's going to be, dependent on how things go with COVID, and how some of the near-term data comes in, to see which economies are going to be able to sort of take advantage and get back to growth. Obviously, Europe not having that large second wave that the U.S. has had also gave them maybe a near-term sort of head start on that front. And we'll see if that carries through.
Do you think we'll see oil prices continue to go higher?
Yeah, oil has been one of the interesting commodities to me because, oil, there was a lot going on with oil. Obviously had the very brutal demand shock as, usage dropped pretty significantly. While at the same time we were sort of having a price war between Saudi and Russia that really sort of shocked the market as well. Storage levels shot up, especially in Cushing. That caused us to have the negative price action on the front month of crude oil that, shocked the world. It was prices that we'd never thought we would ever see. Even to see it go to -40, let alone just going negative, was a huge shock to the market. So, oil prices have done very well, obviously coming back up off those very low levels. Again, using where the low is, I don't like to use the negative price. I think that was more, a one-off and wasn't the heavily traded contract at the time. It was going into expiry. So there was a lot about that, but still, the move back into, above $42 here today, shows that there is some strength, but I think it is also showing, the fact that it hasn't run back or returned to, pre-COVID, levels that is still signaling to me that, yes, the economy has bounced back, but we're still running under capacity. Definitely in the air travel, the jet fuel demand is a lot lower, but gasoline prices over the last couple of months have actually been gasoline futures, the wholesale futures, have been, doing a little worse than the oil price itself. I've also been watching the oil spreads. They've been widening, which tends to be a little bit of an internal bearish signal that we can see in the oil market. So I am very skeptical of the oil market. We have had 3 big inventory draws in oil over the last 3 weeks, which should be a very bullish thing for that market as we're using some of the energy that we have in storage. But over that last 3 weeks, none of that, those big 3 draws have really caused any sharp jump in oil prices like you'd like to see off of bullish news like that. If anything, from 3 weeks ago, we were maybe a dollar lower when we got that first inventory report that showed a large drop. So as a trader, I'm always watching how the market price is going to react to a bullish event like that, bullish or bearish. And when you don't get a bullish price response to what should be a pretty bullish report, that always sort of piques my interest. So again, the fact that the internal contangos are moving a little wider again, Cushing has been a build for the last 6 weeks as well, which tells me that, maybe if we have any more demand issues that we are going to have to watch the storage at Cushing again. Obviously not looking for negative prices again. I think we've learned our lesson from that. But again, that could pressure front month prices, more than back month prices. So I think again that, the oil market is sort of holding steady. The fact that, oil almost tends to trade better just on equity up days is telling me that it's just sort of getting a signal of risk on, risk off. Again, both sort of feeding off maybe vaccine headlines and getting back to normal, which would make sense. But then to me, again, with equities being at or near all-time highs, if there's any pullback in the equity market, I think we could easily see, at this point, a $6 or $7 correction, and crude oil as well. And crude oil, when it does move, can move very quickly. So there is a fair bit of risk in that market at this point. So I'm actually, tilted a little bit, bearish on crude oil right now. I'm exerting that, opinion through contango spreads rather than the outright market, just because there are a lot of things that can happen in the world that, send oil prices dramatically higher, geopolitical risks being one of them, but also, any firm vaccine news here in the U.S. that could bring, traveling, patterns back to normal would likely see a sharp jump in crude oil. So I want to be bearish, but I want to have, my risk covered on that side as well. But, I am bearish, at this price level. Like I say, looking for a pullback. But again, I'm not, hugely bearish. And again, over the medium term, I think we've taken enough investment away from the oil space, where we are going to see U.S. production numbers continue to move lower, into the fall. And I think that's what's going to, sow the seeds for a much better energy market, as we go through the beginning of next year.
Is it surprising the Canadian dollar has remained around 75 cents?
Yeah, for me, the Canadian dollar obviously, typically has traded off of, interest rate differentials between the U.S. That's, become a lot less important these days as our interest rates have moved lower in tandem. Also with the, energy market has always been a big impact on the Canadian dollar. But more importantly, I think, is sort of the impact from the big dollar, so the U.S. dollar. And that's where I would say the Canadian dollar has really underperformed in the last little while. Canada has rallied back to be above 75 cents, about 75.5 cents right now. But as far as the cross currencies that it's trading against, it really hasn't done all that well, given the weakness that we've seen in the U.S. dollar. And that, I think, may be tied to, we are the U.S. neighbor, and economically, if the U.S. is likely to struggle a little bit, that will feed through to Canada as well. So I think that, again, everything sort of being tied with this risk on, risk off, motion of, again, equity. And I do think the best barometer, the best indicator we have for that is the S&P 500. And with the S&P 500, at or near, record highs, that does keep a bid in a currency like the Canadian dollar. So I am looking for an opportunity to be on the short side of the Canadian dollar. Like I said, for me, the dollar index is a buy still, down at around the 93 level. So if I'm going to be buying the big dollar, that means I think there's going to be pressure on the other side of those currency spreads. So I would be a seller of the Canadian dollar. Also ties in with my view on crude oil, likely having a pullback as well. But it's all going to take a general sort of risk off to have those views sort of all be correct or all coincide with one another. So really being cautious that, I can have views on different markets, but it's pretty incredible how much of an impact, being right on where the S&P is going to end up, can impact all the other markets, even though you don't think there's a direct link, because we've seen over the last several months, if the S&P is going to be doing better, oil market will do better. Canadian dollar will be doing better. So, really keeping an eye on that. But I do think the Canadian dollar, again, is getting a little stretched from here. I think we could pull back a few cents. But again, waiting and watching for the right opportunity on that front.
Drew, thank you so much for chatting with us.
Thanks for having me on again, Jim. It was great.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. Check out his websites, pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.